Good afternoon, everybody. Thank you for joining us for today's webinar, where all of you are going to get all of the answers of what taxation is going to look like in 2025, 2026, and beyond. For those of you who have been paying attention over the last 4 years, you know that there could be nothing further from the truth, but we are going to give you at least our take on what we see coming, both in 2025 and 2026. My name is Mark Heath, and I'm Partner and Director of Tax Services here at McKonly Asbury. And at McKonly Asbury, we are an accounting and business advisory firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia, Pennsylvania. We offer a wide range of services to organizations in various industries. If you'd like more information, please visit our website. Hopefully all of you have joined us on past webinars. Welcome back if you have. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on in the world of accounting, tax, and consulting services. Be sure to check out our website, www.macpas.com, to catch past presentations as well as current information through our blog. Now, I know none of you are here just for the CPE, but it is a benefit that we offer. So if you are interested in CPE, please make sure you pay attention to the polling questions. I try to make a big deal when the polling questions pop up because I know that sometimes they're easy to miss because you're so enthralled by the content. But we have our first one here. If you wish to receive CPE for attending today's webinar, please smash that yes button. If you don't, hit no. You can hit yes too. I'm not sure it matters, honestly. But that's our first polling question for today. And remember, you must answer all 4 polling questions to get your CPE certificate. And that'll come via email a few weeks from now. So we're going to leave this up for another couple. There it goes. And we are, there we go. All right, 90% of you looking for CPE. I'm not shocked. That's good. So, all right. Where are we at here? All right. Here's what we're going to talk about today. Current tax law and how we got here, what we think may happen in 2025, and what, at least as of right now, is coming in 2026. The Federal Corporate Transparency Act, CTA BOI reporting, if you've heard about that. There's a new there's going to be a new Pennsylvania annual reporting requirement. And then we're going to be talking about some state issues specifically for Pennsylvania, grantor trusts and PTE, that's pass-through entity taxes. And then one of my favorite topics that I apologize if you've heard me talk about this before, but we continue to see it pop up and could continue to see it be an issue going forward, a specific issue with S Corps and LLC agreements. All right, current tax law and how we got here. So, somewhat quick of a refresher. So the Tax Cuts and Jobs Act, which was passed at the end of 2017, took effect in 2018, did kind of literally one thing permanently, and that's it. It made the C corporation tax rate 21%, and that is permanent. And people will say to me, well, what makes it permanent? The only thing that makes it permanent is that it doesn't expire. Congress could change that at any point in time if they actually wanted to. So that's what makes it permanent. It requires no legislation to keep it in place. It'll just keep going, meaning it would require legislation to change it. All of the potential changes are at the individual small business level. Everything we have listed there expires after 2025, including the top individual tax rate. Right now, it's at 37%. It's going to be going up to 39.6% in 2026. Again, all of this is absent legislation to extend these. And that it goes back to what the rate was in 2017. And it also increases the rate bracket spread, which means at whatever income levels, if you're currently being taxed at 22% or 25%, maybe that's gonna be bump up to 26%, depending on what bracket you fall into. Then next up, the standard deduction. Excuse me, this is one of my favorite kind of switcheroos. They made a huge deal about that. They doubled the standard deduction. The problem was they eliminated personal exemptions. So they didn't really double the total deductions that's made available to everybody, but they like to tout that standard deduction doubling. So the standard deduction would go back down, but personal exemptions would come back. So that means you would get a bigger deduction via the personal exemptions, regardless of whether or not you itemize deductions, and would make it easier to itemize deductions. Next piece, they capped the state and local tax deduction at $10,000. That's called the SALT cap. That would go away. Right now, under the new law, well, it's new since 2018, the AMT exemptions, there's a whole ton of people not paying AMT anymore who were paying it in 2017. So if all this goes away, there'd be a lot more people paying AMT, which is a fun surprise for everyone who likes paying more tax. For the rest of us who would prefer to not pay quite as much tax, it is not a fun surprise. Increase the child tax credit, that would go back down, although there have been some other pieces of legislation since then. It would overall, it would go back to what it used to be. In 18, the miscellaneous itemized deductions were suspended, so anything above that 2% floor of AGI, that would come back. You'd be able to get those deductions again. And then they dramatically increased the estate tax exemption, which would go back to what it was pre-2018 levels if they don't get any of this extended. Other pieces, bonus depreciation. This is all based on calendar year, which gets fun. The phase out, and by calendar year, I mean that's when the assets are placed in service. So if you're a fiscal year company and you placed something in service in what would be your 2024 2025 tax year, because it ends in the previous year, you would have to look at when the asset was placed in service. So we have plenty of fiscal year clients who, depending on when the asset was placed in service, maybe they're getting a 60% deduction if it was placed in service in 2024, and then 2025 is 40%, but it goes down 20 percentage points per year. We've already seen in the past where the phase out of bonus depreciation was phased out. Maybe they'll do that again, who knows? And then the final sneaky, really painful piece is this R&D capitalization. This is Internal Revenue Code Section 174. Came into being, it came in with the Tax Cuts and Jobs Act, but it didn't take effect really until 2022. So everybody kind of forgot about it. The plan all along was to repeal it right after the Tax Cuts and Jobs Act was passed. Obviously, there was some unforeseen things happening in 2018 or 2020 and beyond, and they just never got it done. So here we are. They keep telling us it's going to be repealed, but nothing yet. So now you're going to say to me, well, what's the big deal? Like, how did we get here, and why does it matter? Why didn't they just make all of these things permanent? When they did the 21% rate for C corporations. So now we get into what's going to be coming in 2026. Basically the reverse of everything I just said. So like we just talked about, C corporations, the rate would stay at 21% because remember, that's permanent. The top rate would go back to 39.6%, like we talked about. Brackets get compressed, so everybody's tax would go up at least marginally via a higher marginal rate. Standard deduction goes down, but personal exemptions come back. The QBI deduction, this we didn't talk about on the previous page, so we're going to talk about it now. The QBI deduction, this was for flow-through entities where you get a 20% reduction of your qualified business income to kind of make flow-through entities whole when compared to C corporations. Because if all business income, flow-through business income was going to be taxed at a max rate of 39.6%, and C corporations were being taxed at 21%, that would have been the end pretty much of flow-through entities. Because at least from a tax standpoint, you never want the tax answer to drive the business decision, but that would be a hefty price to pay if you're going to be paying tax at 39.6% instead of 21%, regardless of the double taxation that goes along with C corporations. So that QBI deduction, that goes away in 2026 as we stand right now. The SALT cap, that would be a good answer for taxpayers. The SALT cap would be eliminated, which means you'd be able to deduct all your state taxes. However, AMT would definitely come back into play because there's a specific add back if your state tax deduction goes too high. So if your state tax deduction goes too high, you're probably going to be kicked into AMT and you might pay some more tax. And the state tax exemption would go back to $5 million. And that, excuse me, that $5 million would be indexed for inflation rolling forward from 2017. So I forget exactly what it would be. So it'd probably be like, $6.5 million, which, most people look at that and be like, whoop-de-doo, what's the big deal if we go from a state tax exemption right now, it's like 13 million per person, back down to 5 million per person, who cares? I'm not worth $5 million. What do I care? Well, I mean, yeah, maybe you're not worth $5 million. You don't think you're worth $5 million. But what has happened to real estate in the past however long? Do you have a couple rental properties? Do you own a business that has real estate in it? Has that real estate appreciated to a point where you're now, if you roll all that up, all of a sudden now you're worth $6 million and you now have $1 million worth of estate tax exposure should the unfortunate occur, and it's a 40% rate. So you could be looking at $400,000 in tax that you had no idea was coming. So something to pay attention to. Right now, a lot of people are exempt from it with the current cap. There's been a ton of estate planning going on. I'm not going to say there are, but I wouldn't be surprised if there were. Lawyers out there with multiple sets of agreements ready to be signed on December 31, 2025, depending on which way the legislative wind blows in the next year, where one of those documents at the end of December is going to get signed and the other document is going to go in the shredder. So there are planning things that you can do, just keep that in mind. Now, what do we think is going to happen in 2025? I'm laughing because I have no idea. Everything we thought was going to happen in the last 4 years, 5 years, 6 years didn't happen. And even stuff right now, like we have a spending bill to keep the government open that we thought we had bipartisan agreement on, looks like all of a sudden we don't have bipartisan agreement on. And that's been the trend that we've seen, where in normal political times, when you had a bipartisan agreement, the stuff got done. But the problem right now is there's so much out there that both sides of the aisle in Congress agree on, yet it's not getting done. It's not getting passed. So when we can't get stuff passed that we agree on, what makes you think that we're going to get something passed that people don't necessarily agree on? And taxes and extending the Tax Cuts and Jobs Act is one of those things. So back to the original kind of point here, where we talked about, we keep saying extend them, they expire. Why do they expire? So back in 2017, the Trump administration had control of all three branches of government. Well, I guess two of them, Congress and the executive branch. They didn't have control of the Supreme Court, but they had the executive branch and they had Congress. So they could kind of do, to a certain extent, what they wanted, with the exception that you needed to get 60 votes to pass a tax cut bill. So they knew they were never going to get 60 votes. So what did they do? They pass it through what's called budget reconciliation. Taxes are clearly a budget item, so it can be included in the budget. The problem is under budget reconciliation, you can say, we only need 51 votes to pass this. We don't need 60. But in order to pass something with only 51 votes under the budget reconciliation rules, it can only increase the deficit like $1 trillion over 10 years, something like that. So in order to get under that $1 trillion cap, they had to say, okay, all of the individual and flow-through business provisions, they're going to expire after 2025. That was the only way to get the math to work. There were other things like the 174 we mentioned earlier. They had to put that in there in order to raise revenue, to make the budget to make the budget deficit work, and a couple other the revenue raisers like the $10,000 salt cap. They had to do those in order to make the budget deficit work to get past under budget reconciliation. The other barrier I see here is simple economics. So traditionally, Republican administrations, they want a low tax environment, they want a low spending environment, and they want to balance the budget. So right now, we do have low taxes, but they're slated to go up if they don't do anything. We have very high spending. However, in order to keep the Tax Cuts and Jobs Act in place, the spending would have to decrease so dramatically. We'd be talking about cutting things like Social Security, Medicare, defense spending. I don't see how that would actually happen. Not to mention the third spoke of this wheel is the budget deficit. If we keep taxes low and we can't cut spending to the right amount to make things work, the budget deficit is only going to balloon dramatically. And this is not, a Republican or Democrat thing. The budget deficit has ballooned under every administration, I think, since Clinton. So there's plenty of blame to go around. But the point is here, there's three things here in conflict with each other. And I'm not quite sure how they're going to do this in order to get done what they want to get done, which then brings up the other things here they're talking about on how to do this, except at least the first two are going the other way. No tax on tips. That sounds great. Now we get into a little bit of a mess of what is a tip. So if we all of a sudden lowered our tax fees, but then said, hey, client, here's your bill, but we're going to put on there, feel free to tip us 25%. Is that actually a tip? I don't know. It causes problems. And obviously in our industry, that seems like a pretty far stretch, but start doing this with kind of any service industry where we currently don't tip. The tipping, in my opinion, has gotten a little bit out of control, but this would only make it dramatically worse because now you can get tax-free income. Not to mention the fact that when they say no tax, what does that mean? Does it mean no income tax? Does it mean no payroll tax? Does it mean no unemployment tax? All those things. Is it all of those? Is it just one of those? Is it just a couple? Is it just the employee portion? Is it just the employer portion? Which is it? As we all know, Social Security is already in financial distress. This would only make it worse. The other thing I don't have listed on here, speaking of Social Security, is exempting Social Security from tax, which kind of, it makes sense. Like you're getting paid Social Security based on your earnings, your past earnings, which were already taxed. You paid into this. You're just getting your money back. Why are they taxing it again? The theory behind that and the reasoning is that whether you made, $5 million a year for the past 20 years or $50,000 a year for the past 20 years, you paid into Social Security, and you're going to get, it's just a straight calculation. You're going to get your Social Security back. So the kind of, the political question here is, well, somebody who made $5 million every year for the past 20 years, why are they getting Social Security? Well, the answer is because they paid into it. They're just getting their money back. That's the simple answer. But there is a legitimate question there of, is that the best use of Social Security funding to pay it out to people who don't need it, regardless of the fact that they paid in? The person making $50,000 for the last 10, 20 years could use it a lot more. So kind of that halfway is fine, we'll just tax it again. And they'll at least get some of that back. Presumably the low income individuals receiving Social Security probably wouldn't pay any tax on it. High income individuals receiving Social Security, they would pay tax on it. So, okay, fine, whatever. We'll say that, we'll call that a happy medium. So then the other piece is no tax on overtime. And I'm not a labor law expert, but my understanding of the overtime rules say it only says who must get overtime. I don't think it says who can't get overtime. So because it errs on the side of saying this person is not in a management position, they need to be paid overtime. And obviously all of the employment law claims are all individuals saying I'm supposed to be getting overtime. I should, but I'm not, because I'm not really management. So then all of a sudden, would every single business everywhere all of a sudden say every single employee is now gets overtime? So every hour over 40 hours per week that you earn, that's not going to be subject to tax. Again, we have the same questions. Which taxes? All of them? Income tax, Social Security, payroll, FICA, all that stuff. Is it all of them? Is it just one of them? Which is it? So that's an obvious ambiguity there. And opens the door to get a lot more overtime paid out that was traditionally just paid as a salary. What happens to contracts where, say a fire department, a lot of them will have contracts where we work, individuals work, 72 hours one week, and then the next week they only work 8 hours. So over the course of 2 weeks, it's 80 hours. But in the week one, they worked 72. So how does that work? Is that those 32 hours over the 40 in week one, is that overtime now? Is that free from tax? Even though over the course of 2 weeks, you still only worked 80 hours? How does that work? What about, there are lots of departments, organizations out there that rely heavily on overtime. So is this a much bigger exposure in terms of decreased tax revenue than we originally thought? These are all the questions, legitimate questions, that are being asked by people before we can actually get this done. The other thing is, like we said, Internal Revenue Code section 174. It's just a bad idea. It's a bad implementation. It punishes innovation. By definition, it punishes innovation because what this is it forces you to amortize research and development costs over 5 years if the research and development is done in the United States, and over 10 years if it's performed outside of the United States. It punishes innovation. So you're going to pay more tax if you are doing research and development and also software development. Anything to try to move your business forward, to make changes or whatever, you're paying a tax penalty for this. Not to mention the fact that startups, there are lots of startups where their net cash flow is zero. They have maybe $1 million of revenue, and they have $1 million of wages, all of which are deemed to be research and development expenses. So their net income is zero, their taxable income is zero, their cash flow is zero. But this would require that organization to amortize that $1 million expense over 5 or 10 years, or 15 years actually for a foreign. So all of a sudden you have zero cash, and you now have $800,000 of taxable income. And there are there are companies in that exact scenario that I just described. It was meant to go after big pharma, big tech, and everything. All these companies that are seen as making billions of dollars in profit every year, not paying any tax. It was meant to go after them. To them, it's a blip on the radar because it's just a temporary difference. They're going to get the deduction at some point, just not in year one. It's them. It's just timing. It's hurting all of the tech startups and all of the innovative companies that are doing all kinds of stuff that we never thought a small company would be able to do. So, like we said, and that's one of those, 174 is one of those where everybody agrees it should be repealed, but they just can't get it done. Like we said before, bonus depreciation, is that going to get phased out? That could be a revenue raiser, or it could be extended again. They could just let it phase out, or they could extend it again and be another tax cut. Tariffs, I'm not knowledgeable enough on tariffs to know how this would play into the tax field. All I know is, from what I've read, if you could put 100% tariff on every single import that comes into the United States, and it would still be a drop in the bucket in terms of raising enough revenue to make up for the decrease in revenue of the Tax Cuts and Jobs Act expiring. All right, we are now up for our second polling question of the day. Those of you looking for CPE, make sure you tell us, have you made any changes to your business as a result of current and or pending tax changes? Yes or no? I feel like we should have the Jeopardy music during these polls, because this is the time where I take a drink. So have you made any changes? Have you thought about making any changes? Let us know. All right. Okay, about a little less than 25%. I'd be curious to know what those changes are. If anybody wants to comment, you can put your question into the question thing there, and we'll get it. And that reminds me, if you do have any questions, put them into click the question button, ask your question. They'll get it over to me, and maybe we'll answer it real time, depending on if we can or what it is. Maybe we'll address it at the end, but feel free to ask your questions. All right. Now, switching gears, the Federal Transparency Act and Pennsylvania changes. The Federal Corporate Transparency Act. So what is it? It is it's one of those rules with unintended consequence. I can't even say unintended because everybody saw this coming. So the point of this is to get transparency, hence the name, to the federal government of who owns what. This is kind of a result of all of the concerns that came out of all of those bank accounts, that offshore accounts that are, kind of hidden in shell companies, in trusts that no one can see who owns the trusts, people parking cash and income offshore and getting privacy protection from, Switzerland's always the famous one, Cayman Islands, to avoid taxes. So the federal government said, we're going to make everybody tell us who owns all of these companies, who's making the decisions for all these. I say companies, it's really entities, because the thing is, initially you would say that this probably applies to big companies, right? We don't care about all the little ones. It's actually the reverse. It is for the smaller companies, because there's a large company exemption here. It applies to corporations, LLCs, partnerships, trusts, any legal entity. And what they're going after here is the beneficial owner. And this is where things get tricky. As you can see there, I have in quotes, exercise, quote unquote, substantial control over a reporting entity, or owns, controls 25% or more of a reporting entity. So The 25% one is fairly straightforward. I think there's a pretty clear argument to be made. If you own 20% personally and your minor child owns 5%, you probably have control over 25%. That one's pretty straightforward. The other one is, the thing is though, is substantial control. So say you have a whole bunch of real estate partnerships that are entities, whatever, that roll up, and you pay someone who doesn't own any of it. You pay them to manage all of this, all the real estate, to make the financial decisions, to get the financing, and you've given them signature authority over all of this stuff. They don't own the entities. You own the entities. You own the property. You own the assets. But have you given them substantial control over all of this? In that specific case, that's a very egregious example, but I know examples like that exist. That would be a pretty clear, somebody has substantial control over a reporting entity, even though they don't own 25% or more of it. But there's obviously going to be a pretty large gray area in there of what is substantial control. And so that's why this has become a legal issue. We can assist clients and kind of talk through the rules of who has to file and what the exemptions are. But in terms of who the beneficial owner is, unless it's really clear, we're not in a position to opine on whose name should go on this form. And so we are referring clients to legal counsel. We are also not filing these forms on behalf of clients because it's still unclear as to whether or not this is considered the practice of law. And I would love to not get in trouble for unlicensed practice of law. Lawyers can do taxes, but tax people can't do law. That's one thing that always bothered me, but here we are. The lawyers get really mad at us when we do legal stuff that we're not allowed to do. Not to mention the government gets mad at us. So we're not filing them, but we can talk through the rules and answer questions. So what do you need to do? Pretty straightforward: name, address, state, EIN, then with the beneficial owner, date of birth, and then you need to provide some sort of identification, whether it's a driver's license, passport. Those are the basic ones that we know of. And then now the big question is, when do we file? So for existing companies, that date on there is not wrong. You have to file on or before January 1st. That's in what, 12 days, 13 days. Newly formed companies formed after January 1st, 2024, you have 30 days. They tried to extend that to 90. I'm not sure they actually got it done, but it's technically before January 1. Now, here's the fun part. A court, I believe in Texas, just a couple of weeks ago blocked this, blocked the act. So currently, this act is not in effect. It's on hold. So currently, no one is required to file. However, that could be reversed at any time. Obviously, the federal government's fighting it. Would the incoming administration fight it? I don't know. They say they don't like it, but who knows what would actually happen. The point is, the penalties are huge. So if and clients have asked me, there's a few different buckets of where clients would fall in. They'll say, should I file? Do I have to file? And previously I'd said, yeah, you had to file. Just do it. And but right now the answer is no, technically you do not have to file. However, if you haven't filed yet, I would be ready to go at a moment's notice to push the button to file. And then, the obvious question is, well, why don't you want to file? So here's where there's at least two buckets. The first one is, I don't like the government telling me what to do. I get it. But kind of my response to that is, yeah, I get it. You don't like the government telling you what to do. You don't think you should have to do this. So my question to you is the penalty, which is, you know, 10,000 bucks, I think a pop, is that $10,000 worth it for you to say, government, I don't like you telling me what to do, what I don't want to do, when most likely they have all this information already anyway. You're probably filing a tax return, or you have if you have an EIN, the government knows you exist. They may not know who specifically owns the entity, but they know you exist. If you're filing a tax return, they already have all of this information. Maybe they don't have the beneficial owner, but they have the vast majority of all of this information. So, and by definition, if you have a passport or a driver's license, you individually are already on the government's radar. So, you know, in my opinion, it's kind of like you're not giving the government anything they don't already have. And honestly, the filing is not that hard. We have the link there that you can go file, and so from that standpoint, it's kind of like, you know, yeah, I get it. You want this to be a protest. I can't argue with you one way or the other. Let's just make sure you understand that, you know, there could be a big penalty that you'd have to fight. If 10,000 bucks is nothing to you, hey, have at it. It's a lot to me, so I would probably file. The other piece is there are very complex entity structures set up with the specific intent of secrecy. And for whatever reason, just privacy, maybe you're concerned about someone illegally coming after your assets if they knew that you owned this stuff. There are legitimate reasons for this privacy and this secrecy. And in those cases, it's like, okay, you know, yeah, I think you got a pretty good argument here, because you do have a right to privacy and secrecy, and I think that's what the court is saying, and that's why they've halted the requirement for at least right now. In those cases where someone says, I have a right to privacy, there's a specific reason for this privacy, be it business or personal, and I shouldn't have to do this. In those cases, if that is your big concern, you probably have enough money where 10,000 bucks, you're willing to risk that. Maybe you have 5 entities, 5 trusts or whatever all set up. Maybe it's 50,000. I don't know. But point is, maybe that's why you're thinking this. So that's what we're hearing. That's what we're seeing as it goes into this. But like I said, be ready. Technically today, you don't have to file, but you may very soon. So back to the exemptions we talked about a little bit. Like I said, it's kind of the reverse of what we initially thought this was going to go after. The biggest exception that we see everybody falling under is the large company exemption. If you have more than 20 FTEs, they're all employed in the US, and you have a physical office in the US, and you have more than $5 million in gross receipts, not including foreign gross receipts, then you're exempt. That's kind of the one we see, you know, most companies falling under. There are others, you know, we're an accounting firm. We already have to register, you know, good grief, all over the place. So they already know we exist. One thing that I found interesting was public utilities are exempt from this, but I think you have to be in the energy or oil and gas public utility sector. A transportation company would not be exempt from this as a public utility. So if you go a transportation company as a subsidiary of a larger company, Q-Sub, whatever, and you know, you have 10 drivers, and the gross receipts of the transportation company is $2.5 million. Maybe you don't have a physical office because you just have trucks, and they park on the property of the operating company. You could get caught up in this. So make sure you look at it. In there, we have all of the links to all of the information if you want to go check it out. We do have a company by the name of Harbor Compliance that we do a decent amount of work with. They have a solution for this that you can go take a look. They will file on your behalf. You just have to give them all the information. Next up, polling question number 3. So if you're looking for CPE, here you go. Where do you stand on CTA, Corporate Transparency Act, and BOI, Beneficial Ownership Information Reporting? Have you already filed? You're waiting until the last minute, and that's by choice, or it doesn't apply to you. Tell us where you're at on this reporting. All right. All right, 30% of you. Oh yeah, almost 20% waiting until the last minute. Yeah, it's not, that doesn't surprise me. I know there's a lot of companies doing that. Like I said, just be ready to go, because we have no idea what it's going to look like if that court injunction gets overturned, and we have no idea how much time you're going to have to file. So just make sure you're on top of that one. All right, now moving on to this new Pennsylvania annual report filing. It's going to be effective for 2025, and it applies to all entities registered to do business in Pennsylvania. When is it going to take effect? Or when do you have to file? For corporations, for-profit and exempt, you have to file by June 30th, 2025. For LLCs, you have to file September 30th, 2025. LPs, GPs, anybody else by the end of 2025. And in there is a link to all the fun rules as it relates to that. So not to, and one thing, all nonprofits are already required to register every year in Pennsylvania. So they're already taken care of. It's just everybody else. All right. Grantor trusts and pass-through entity taxes, two of my favorite topics where Pennsylvania continues to be inept. Last year, a couple years ago, Pennsylvania made a big deal about lowering the C corporation tax rate. They phased it down to, I think, 4.99%. Finally, it would get to that in 2031. Two other just easy fixes that I don't understand why they haven't addressed until now are grantor, well, they're only addressed one of them now, grantor trusts and PTE. So as part of estate planning, business succession planning, grantor trusts are being used all over the place to move assets, to get ownership to the next generation, keep the family business in the family. And 49 out of the 50 states, well, at least those where there's an income tax where this matters, they do not recognize grantor trusts, which means they don't exist for purposes of income taxes. And when you file a state income tax return, the income that's coming from the flow-through entity that flows into this grantor trust just goes straight through to the beneficiary and is reported on the beneficiary's state income tax return. Real simple. Well, Pennsylvania has forever until now said, no, we're going to recognize grantor trust. This thing looks fun. We're going to tax this grantor trust by itself. So the income comes from the entity, goes into the grantor trust, and the trust has to pay the tax on it. Here's the second fun part. Pennsylvania requires non-resident withholding for everybody. If you have a income flowing from a flow-through entity into a shareholder or a partner who is a non-resident, well, many trusts are not PA residents. They're either Delaware residents, a lot, Nevada residents, or South Dakota residents. So now the entity has the operating company has to pay the tax on behalf of the trust, and then the trust claims that payment on their return. And it's a distribution, it's deemed to be a distribution out to the trust, which just, it's annoying. It's counter to everything else that we have to do. And it's inconsistent with literally every other state. Well, Pennsylvania finally got on board. So starting in 2025, they're changing it, and they're just getting on board with every other state. So thank goodness they finally figured this out. the thing you need to be aware of is this is going to change estimated payments. So payments for 2025 income tax are going to start in 2025. So where previously, if you're doing everything the right way, the operating company would pay on behalf of, would withhold on behalf of non-resident trusts. Now you have to look at the beneficiary, and if the beneficiary is a PA resident, then you don't have to withhold on their behalf, and it has to be the beneficiary paying the tax. So I could see a problem where if you don't get this right and you start making estimated payments, if you continue to make estimated payments on behalf of the trust, or if the trust itself makes the estimated payments, I could see a scenario where Pennsylvania is going to, you're going to have to file a trust return to get the tax back, to get a refund, and then Pennsylvania is going to say, well, the beneficiary, they're on their PA 40, they're late. They didn't pay anything in. So you could rack up some pretty hefty interest and penalties there. Can I see a world where Pennsylvania would say, okay, look, we get it. You can just transfer the payments from the trust to the beneficiary, maybe. But I haven't, if Pennsylvania said they can do that, I haven't heard it. So be aware of that. Then the PTE, the pass-through entity tax. So PA is not quite as much an outlier here as they were with the grantor trust thing, but pass-through entity taxes, this is what states said to the federal government as a result of the SALT cap of 10 grand that we talked about earlier, PTE. They said, okay, fine, you can't deduct the state taxes on your individual federal return. We're going to let you say that the tax that is on the income of a flow-through entity is now actually going to be an entity level tax, which means the entity deducts the tax, and so you're getting the full benefit to offset your federal income tax liability. Whole bunch of states have done this. Of course, to make everyone's lives easier, every state has done it differently. Some you have to file an election, some you just do it, some you have to tell them in advance that you're doing it, some you don't. If you do it the wrong way, it could get messed up. So that exists, but Pennsylvania has said, no, we're not going to have a PTE tax. But so then the question is, okay, if I'm a shareholder in a company that pays taxes in a whole bunch of other states, and we do PTE tax in all of these other states, Pennsylvania, are you going to allow me as a Pennsylvania shareholder to get a credit for the taxes paid on that income in the other state? Because in Pennsylvania, all of the income is taxed, and then I have to get a credit for the taxes paid on the same income to another state. Pennsylvania has said, oh yeah, sure, but only for S corporation shareholders, not for partners and partnerships. That's a problem. Obviously, it's a problem for partnerships. It's a problem constitutionally. So Pennsylvania's constitution says that you can't tax two shareholders or two taxpayers differently. This would be the definition of treating two different taxpayers differently. You could be treating the same taxpayer differently depending on whether they say they're an owner in S corp and they're also a partner in a partnership. Ton of people like that out there. On one side, they're getting a benefit for the PTE. On the other side, they're not. So there have been some people fighting this, or at least making a refund claim to kind of protect their investment in this, in hopes that this will eventually go to court. And I think the court would kick it out pretty quickly if somebody wanted to do it. This reminds me of, everybody remember Nextel phones, little, push to talk things, we go beep beep. Nextel, like most tech startups, had massive losses, net operating losses. And Pennsylvania's old net operating loss rules were you could deduct, I think, up to $5,000 of NOL per year, the max of that, or 20%, I think it was, I don't know what the percentage was, of your taxable income. And Nextel said, that's not fair. That's in violation of the Pennsylvania Constitution. We're going to challenge this. You need to treat everybody the same. So PA said, so the court ruled and said, yeah, sorry, PA Department of Revenue, they're right. You can't do this. And so Pennsylvania said, fine, everybody assumed they were just going to remove the percentage limitation and say everybody can deduct up to $5 million of NOL because that would benefit the most taxpayers and yet still probably limit Nextel's NOL utilization. They went full bore and just said, you know what, we're just going to screw everybody and say, no, we're just going to limit you. We're just going to say you can only deduct X amount of your taxable income. NOLs up to a certain percentage of your taxable income every year. Ended up screwing everybody. So if this goes to court and it gets overturned, is the PA Department of Revenue going to say, okay, fine, S corps, you can't deduct it either. You can't take the credit for taxes paid to other states either, just out of spite. And here's the even more fun part. Back in the NOL issue, they told all the people, because it's a constitutional issue, it goes back to the beginning of time. There's no statute of limitations. You can't just say it's going forward. Pennsylvania said, people who have already done deducted all the NOLs, we're not going to come after you for prior years. Don't worry about it. We're just going to look the other way. Would they do this here, where they say, S corporation shareholders, where you've taken the credit for taxes paid to other states, in prior years, we're going to, we're not going to come after you. Don't worry about it. We shall see. All right, polling question number 4. Will the change to grantor trusts impact you or your business? Hopefully, if you have any involvement with grantor trusts, it'll make your lives a little more simple. CPE, make sure you get your answer in. It's only going to be up for a few more seconds. All right. Kind of thought that. Yeah, 20%. Okay. Makes sense. All right, our final topic for the day, what I like to call the S Corp, LLC S Corp trap. Private letter ruling 2022-47004, which means this was a ruling from the IRS in 2022, tells us how the IRS is going to look at S corporations that are also LLCs that have clauses in their operating agreements which are not consistent with the S Corp rules. You would think, kind of on the surface, it's like, well, how would that happen? And you know what the S Corp rules are. One class of stock, you make sure your distributions are pro rata. Don't worry about it. Well, if you have an operating agreement, if you set up a simple LLC, we actually had somebody in the comments as a response to the changes in tax law, pending potential changes in tax law, said they changed from LLC to S Corp to help save on end of year taxes. This would be one thing to review. Did you set up an LLC and you got a boilerplate partnership agreement that says, because the default taxation for LLCs is you're going to be taxed as a partnership? Did you just say, we're just going to use a boilerplate one, we're not complicated, everything's 50-50, we're fine, whatever. And in that partnership agreement, does a reference to Internal Revenue Code section 704B. 704B states that upon liquidation of the partnership, among other things, it says upon liquidation of the partnership, everybody gets distribution in accordance with their capital accounts, and it applies to a whole bunch of other stuff. Everything has to be applied in concert with your capital accounts. That is in direct violation of the S Corp rules, which say everybody gets the same treatment in terms of distributions based on their percentage ownership. You cannot have two classes of stock where somebody gets a preferred distribution. No matter what your basis is, no matter how much you've contributed to the company, no matter how much you paid for the stock, you have to be treated the same as everybody else. So by definition, the 704B rules are in violation of that. Even if you haven't done anything wrong, just having this agreement technically means you never had a valid S election. So that's the bad news. The good news is they will forgive you. Further bad news, it's very expensive to get them to forgive you. The IRS in this private letter ruling said, hey, yeah, we can just see this was an honest mistake. You didn't do anything wrong in terms of your operations or your distributions, but technically you never had a valid S election. So the choice is yours. You either go, actually, you can't just go back to being a partnership, because by making an S election, you've deemed to be taxed as a corporation and then an S corporation. They're going to say, well, technically from day one you were a C corp, so you probably owe some tax and you don't get the benefit of single level of taxation. That's the cost in this. Have I ever seen this happen? No, I've never seen it. I have seen an example or a situation where a shareholder put their S corp stock into an IRA, which is an ineligible shareholder for an S corporation. So we had to go through the same process. Very expensive. Not only to the shareholder, who had to go back and pay all their back taxes because they thought they'd found a loophole and the income wasn't going to be taxed since it was sitting in their IRA. And the company had to request a private letter ruling, which at the time I think was like 30 grand. This was a long time ago. But they just had to pay $30,000 and write out a plan that says, here's what happened. We didn't know it happened. We just found this out. And the shareholder is amending all their tax returns, paying all the tax they have due. Please forgive us. And the IRS said, yeah, don't worry about it. You're good. Thank you for the $30,000. So something to be aware of. Make sure it's on your radar. So thank you, everyone, for joining us today. I know tax is everyone's favorite topic. And there's nothing better to talk about than taxes at the end of December. So if you have any further questions regarding today's presentation, I do see there are a couple in the chat. We're going to try to get those answers to those out afterwards, after we're done today. And if anybody has any other questions, feel free to reach out and we can get them answered for you. A recording of today's presentation will be posted on our website and social media sites in the next couple weeks. And for those of you who requested CPE and answered all the polling questions, those certificates will be sent out via email within the next 2 weeks. Upcoming, January 30th is our next webinar. This was, like I said, this was our last webinar for 2024. We'll be back up in 2025. January 30th is our next one, and we're going to be talking about employee benefit plans. Thank you for joining us, and I hope everybody has a wonderful holiday season and a happy new year. Thank you.